if you invest with a much higher margin of safety in a fair business, let's say you get 50%, you just pay 50 cents on the dollar, or you pay 30 cents less than the actual fair value. So you don't get that bargain, but for the much better business quality, then now for a couple of years, actually the performance might be similar. But over the long term, the business with better quality wins by a huge margin. And of course, one of those aspects is that you could look at the compounding of the interest, where you then generate, if you have 20% return on investment, or let's say 25% ROE, basically you get those wonderful results over the long term. And that's critical for the long-term investor. Now, we define that aspect, which Charlie and Warren pointed out, as modern value. And this is the way to describe that value investing is not just Graham-style value investing. Not that Graham didn't get that aspect, but it is associated and linked to just the typical low PE, low price book, etc. That's what value investing is typically associated with. Now, that is what I think is completely wrong. And this is why I labeled this as modern value. And modern value is basically, when you think about the trick Charlie shared with us, it's about the quality of the businesses, the quality of the companies you invest in. So what we're looking for is growth dynamics. So we like growth, and value and growth are not opposed. Growth is always a part of the equation that you have to get comfortable with and understand what drives growth, what is the total addressable market, what is the market size. And then we look for business models where we already have a hint, because the returns on capital are above 20%, ideally above 25%. And then we think, could this be a great business? Is there a moat protecting us? And the best businesses clearly have a reinvestment opportunity. And then they get incrementally better results by reinvesting, and they can grow maybe even at a rate above 10% on the top line. So these are the wonderful businesses that we are looking for. Now, what really qualifies as a wonderful business, because that gives us the comfort that we will be benefiting from those returns for a long time, are those structural competitive advantages, the moat that protects us and from management mistakes, from any adverse issues in the market, etc. In order to not be too aggressive, we really like moderate debt levels. Of course, some very stable businesses can handle more debt, but in general, we don't like debt, because in the end, the bank is in control, and we don't like that. In order to have the management aligned with us, we prefer family or owner-managed businesses, or at least the incentives which are similar to those structures, because that is basically what will enable those long-term decisions, which are sustainably, economically sustainable, wonderful long-term decisions, where you don't hire and fire, but actually you keep the great people that will get you the next level of growth once you are going through recession. Not that we've had many recessions. They've been through the central bank efforts and the fiscal impulses that we've seen. They've been smoothed over to a degree that's unimaginable, actually.